Welcome to LR Reports. This episode is based on institutional research published by a leading global financial firm. We focus on the core investment thesis, key assumptions, and material risks outlined in the original report.
If 2025 felt like fighting against a relentless macroeconomic headwind, the consensus for 2026 suggests the wind is, well, finally at our backs.
But it's not a simple return to normal.
No, not at all. It's a structural shift that really demands we look at markets differently. We're diving deep today into the source material that lays out this very change.
That's right. Our focus is the 2026 Global Strategy Outlook, the Year of Risk Reboot, which was published by Morgan Stanley on November 16th, 2025.
And the report is blunt.
It is. It says the market is moving decisively away from those broad, cross-asset macro headwinds and shifting toward hyper-specific micro-fundamentals.
And the immediate conclusion is extremely constructive. Risk assets are primed for a strong year. This isn't just wishful thinking. It's anchored by two massive reinforcing themes.
Accelerating AI capital expenditure and what the firm calls an unusually favorable policy backdrop.
They frame 2026 as the Year of Risk Reboot. Why that phrase? Because the old rules of risk management are fundamentally changing.
That reboot framing is key. It's not a cyclical recovery. It's a change in the market regime. To understand why risk assets are poised to perform, we have to start with the source of this supportive environment,
Which they dub the policy triumvirate.
Exactly, the simultaneous operation of this triumvirate.
Okay, so let's unpack this unusual policy convergence. We're talking about fiscal policy, monetary policy, and deregulation, all pulling in the same direction. What makes this alignment so interesting right now?
Well, what's fascinating here is that this kind of synchronized pro-cyclical policy mix where policy is explicitly stimulating growth, it almost never happens when the economy is not in or emerging from a recession.
So outside of a downturn, policymakers are usually tapping the brakes, not the gas.
Precisely. We're seeing recession-era policy support.
Applied to an economy that is stabilizing or even expanding.
Exactly. Morgan Stanley highlights the historical rarity. The only other time in the last 50 years when the Federal Reserve was actively easing rates and U.S. government debt to GDP was rising outside of recession was, I think, briefly in the late 1980s.
So this setup is fundamentally anomalous. It's just injecting significant fuel into the system.
Right, just as growth stabilizes.
Okay, if we detail the components, let's start with the monetary lever. What is the forecast for rate easing globally?
The expectation is for front-loaded easing. In the U.S., the Fed is forecasted to cut rates by 50 basis points in the first half of 2026.
And crucially, they're easing into a stabilizing macro environment. That signals confidence, not panic.
That's the key. And in Europe, the ECB is expected to bring rates down to 1.5%. This coordinated dovish shift provides a powerful tailwind.
And the fiscal side is providing direct stimulus. The source points to the One Big Beautiful Bill Act, or OBBB.
Which translates into a significant corporate tax reduction. We're talking U.S. $129 billion.
You couple that with an expected prioritization of deregulation, and you have cheaper money, a huge boost to corporate cash flow, and fewer regulatory hurdles.
It's the definition of a growth-supportive convergence. But while this triumvirate is a global story in its implications, the report is very, very clear on where the core impetus lies.
It's the U.S.
It's the U.S.
So U.S. strength acts as the epicenter, driving global outcomes. How does this policy fire contrast with what's happening in other major economic blocs?
The U.S. is expected to remain the most likely driver of any material upside to global growth. And conversely, the biggest risk to the global outlook would be a miscalculation originating in the U.S.
It creates this massive dispersion.
A huge dispersion. Europe is still dealing with its structural challenges, intense competition from China in key sectors. So it's a tepid forecast.
And emerging markets.
Also constrained by the slow pace of reflation in China.
But are there any bright spots in the EM landscape that buck this trend?
Absolutely. The report flags exceptions where the local micronarratives really override that dampened macro picture. Specifically, they favor EM equities in Brazil and India.
Okay, so what's the story there?
For India, it's strong domestic credit growth and structural reforms. For Brazil, you have a compelling combination of high return on equity and, comparatively low valuations.
So it's a testament to the report's central thesis. Look past the macro noise and find the idiosyncratic drivers.
Exactly.
That perfectly transitions us to that central idiosyncratic driver, the enormous wave of capital expenditure required to fuel the AI revolution. This isn't just a theme. This is a structural market force.
It truly is the core microstory that defines the 2026 outlook. I mean, the scale of the required investment is mind-boggling.
Give us the number.
Morgan Stanley projects nearly $3 trillion in data center and related capex through 2028.
$3 trillion. That's a figure that can feel abstract.
Yeah.
To put that in perspective, that's roughly the size of the entire German economy.
It is. And the key is that the spending isn't sitting on a cash flow runway ready to go.
So it's not fully funded internally.
Precisely. The report estimates a financing gap of approximately $1.5 trillion that needs to be sourced through external credit channels.
And this enormous supply burden has immediate and specific implications, especially for fixed income.
That's right.
And those implications hit the investment grade or IG market first and hardest. Why there?
That's the critical nuance. The supply will predominantly be issued by these mega cap tech and AI companies who are mostly IG rated. And while their balance sheets are robust, the sheer volume of issuance,
The 1.5 trillion need.
right, it will structurally widen investment grade spreads. The market needs to compensate for that unprecedented supply.
So it's a supply story, not a credit quality story.
Exactly. And it creates a huge relative value trade for investors.
Okay, so let's shift to the resulting asset allocation strategy. Given this supportive triumvirate and the AI driver, the firm recommends a clear risk-on tilt. What does that mean for equities?
It means a strong preference for U.S. equities. They're expected to lead the pack. The S&P 500 target is set pretty aggressively at 7,800 for the end of 2026.
Driven by what? Not multiple expansion, I assume?
No, by earnings growth. Specifically, positive operating leverage and the efficiency gains from AI adoption boosting EPS.
But wait, that S&P target seems highly aggressive when we look at current valuations. The report itself notes the CPE ratio is already trading at 38 times. That's right back near the rich extremes of 2022.
It is.
So how do they justify such a constructive equity call without a valuation anchor?
That is the essential challenge, and they address it head on. This is not a valuation-based call.
Okay.
The defense is rooted entirely in the policy triumvirate, which historically can sustain rich valuations for longer than traditional models predict. If the conditions hold, the market relies on realized earnings growth, the E and the PE, to justify the prices.
So it's an explicit acknowledgement that the macro support is overriding classical valuation concerns, at least for now.
In the short term, yeah.
Okay, that clarifies the aggressive equity position. Moving over to credit, where the AI financing story creates that structural fault line.
Yeah.
What's the key rotation trade away from US IG?
The rotation is simple. Avoid the issuance spike. You want segments insulated from the AI supply,
Which means?
which means favoring U.S. high-yield and agency mortgage-backed securities, MBS. These segments don't face the same structural headwind as IG.
And the report also suggests that European credit will outperform US credit. Why that divergence?
It comes down to corporate behavior, or what the strategists call animal spirits.
Animal spirits.
In the U.S., the policy mix is encouraging rapid M&A and aggressive capex. U.S. corporations are using cheap debt aggressively.
Increasing leverage risk.
Right. In contrast, Europe is showing less of those animal spirits. European executives are still acting cautiously, meaning less aggressive borrowing and therefore lower risk in their credit markets.
Let's look at the rates market now. We need to talk about curve steepening, but what does the report mean by bull steepening?
They're looking for material UST curve bull steepening in the first half of 2026.
And to define that simply for everyone.
It means the entire curve is falling, rates are declining, but the short end of the curve falls faster than the long end.
Okay, and what's driving that?
It's driven by the front end repricing in those expected 50 basis points of Fed easing. The forecast sees the U.S. 20 cents curve reaching 145 basis points.
145. That's a level we haven't seen since 2021. What does a steepening of that magnitude imply for portfolio managers?
It implies that holding long-duration assets, the 10-year or 30-year bonds, will underperform short-term T-bills in the first half of the year, even as rates are falling.
Because of the magnitude of that front-end move.
Precisely. This is a front-end impulse story. It really validates positioning risk at the front of the curve.
Let's close out the allocation review with FX. The dollar index DXY is expected to have a year of two halves. What drives that transition?
Yes, the DXY weakens into the second quarter of 2026 as the existing USD bear regime continues.
Supported by falling U.S. rates and strong risk appetite.
Exactly. However, in the second half of the year, the focus shifts to what they call a carry regime.
And just quickly, for listeners who need a refresher on the carry regime,
It just means investors are primarily focused on earning the interest rate differential between two currencies. As policy clarity improves, the dollar's high nominal rates make it attractive for investors seeking that carry.
so the net results.
The dollar ends 2026 roughly unchanged. It's neither a major drag nor a major driver of outperformance for international investors.
That gives us a robust baseline. But of course, every aggressive forecast is flanked by critical fault lines.
Let's pivot to the key risks that could derail this base case.
And they state these are fundamentally driven by U.S.-led shocks. The most immediate risk is an abrupt end to the AI investment cycle.
We've priced in this $3 trillion spending spree.
Right. So if that pace of AI capex suddenly decelerates sharply, it would immediately pressure U.S. equities, given the heavy index weight of the hyperscalers.
And the interesting counterpoint here is that an end to the AI cycle would actually help the fixed income market we just discussed.
That's the vital correlation breakdown. A sharp pullback in AI capex would alleviate that enormous issue and supply pressure in the IG market. So IG credit would likely tighten and benefit.
It's a perfect example of how diversification is shifting from macro correlations to idiosyncratic risk.
What about the risk that sentiment runs too hot? We are already banking on a lot of optimism.
That is the risk of overheated animal spirits, irrational exuberance. If risk appetite runs irrationally high, the tactical allocation favoring cyclicals and high beta assets would be wrong.
Because late in the cycle,
Historically, late cycle expansions see IG credit eventually outperform both high yield and equities as investors seek safety, a complete reversal of the base case.
and the perennial concern, what if the Fed changes its reaction function?
That's the biggest uncertainty. A shift in the FOMC's priorities could lead the Fed to be unexpectedly inflation tolerant. This would immediately steepen the UST curve.
But how risk assets perform hinges crucially on the type of steepening.
It's everything. If it's our base case bull steepening driven by cuts, risk assets rally. But if the Fed is seen as losing control, you get twist steepening, where longer-term rates rise.
Due to higher inflation expectations.
Right. And that scenario would kill duration performance and introduce genuine systemic fear back into markets.
That distinction is paramount. Beyond those core risks, the report outlines 3 U.S.-driven alternative scenarios. Can you quickly contrast the 2 upside scenarios?
Certainly. The first is demand-driven. This assumes the policy triumvirate works too well. Strong growth, but also rising inflation.
Which means the Fed is forced to shift from easing.
To eventual rate hikes, causing a mid-cycle correction.
And the more benign upside.
That's the productivity-driven scenario. This assumes rapid AI adoption delivers enormous productivity gains, which acts as a powerful disinflationary force.
The Goldilocks scenario.
The absolute Goldilocks. The Fed can continue cutting rates despite solid growth.
Finally, the downside scenario. The mild recession case.
This assumes lingering policy lags and external risks like tariffs trigger a moderate slowdown. The Fed would be forced to cut rates aggressively, but the recession would be mild enough that rates wouldn't need to go to zero.
Before we wrap up, a quick look at commodities, which provides a dose of caution to an otherwise risk-on outlook.
Especially regarding energy.
The view is decisively metals over energy.
It is. Brent crude is expected to stay anchored around $60 a barrel throughout 2026. This is driven entirely by a supply-demand imbalance.
Meaning,
Non-OPEC supply is growing robustly, and the report forecasts a temporary supply surplus that could reach roughly 3 million barrels per day in the first half of 2026. Supply just outweighs demand.
but gold is the clear metal favorite, even with rates falling.
Gold remains the top pick. The forecast is remarkable, $4,500 an ounce.
And that's supported by what?
2 factors. Macro tailwinds like falling real rates and sustained physical demand, particularly from central banks continuing to diversify their reserves. Separately, they also favor copper and aluminum.
So wrapping up this deep dive, the core takeaway is the operational shift for investors. We're moving from a world dominated by macro correlation
Where everything moved together.
to one defined by highly asset-specific micro-narratives. AI financing pressure on IG, regional policy divergence, unique drivers in EM.
It forces investors to think about risk at the specific asset level, rather than relying on broad hedges. And here is a final provocative thought for you to consider.
Go on.
This confluence of pro-cyclical fiscal policy, monetary easing, and broad deregulation is, as we noted, highly anomalous outside a recession. Policymakers are effectively pouring high-octane fuel onto an economy that is already running warm.
So the question isn't just about 2026.
Exactly. The question you need to mull over is not whether risk assets perform well in 2026, but what the structural implications are for the years that follow. How long can this engine run hot without causing the kind of sustained structural inflation or portfolio volatility that current models just aren't pricing in?
You have been listening to LR Reports. This content is for informational purposes only and does not constitute investment advice.